Hello, welcome to Module 3, Part 1. My name is Sarah Quirke. I'm the Head of Investment Solutions here at Goodbody. I'll be your guide throughout Module 3, during which we're going to cover stock classification, how to pick your first stocks, evaluating companies, and interpreting the company results. As you know, a big part of a successful investor is diversification. And when you're looking to diversify, the types of stocks that you have in your portfolio need to look at a company's size, sector, and style. Let's start with size, which when it comes to a stock is called market capitalization. Market capitalization, or market cap for short, refers to the total value of a company's shares of a stock. It's calculated by multiplying the stock price by its total number of outstanding shares. So for example, if a company has 900 million shares at about $500 a share, the market capitalization is roughly $450 billion. Companies are generally grouped into one of three categories based on their market cap. Large cap companies are typically those that have a market cap of over 10 billion or more. These companies are generally well established and are leading players in their respective industries. They tend to be less vulnerable to economic downturns due to their large financial resources. In the short term, investing in large cap stocks does not bring big returns, but over the longer term, investors will generally see a consistent increase in their share value and dividend payments. Mid-cap companies typically have a market cap of between 2 and 10 billion. These companies are generally expected to experience or are experiencing rapid growth. As they carry more growth potential than larger caps, they tend to be higher risk. And lastly, companies with a market cap of between 300 million and 2 billion tend to be called small cap. They are typically younger companies operating in niche areas of the market or new industries. They have significant growth potential, but are considered high risk relative to their mid-cap and large-cap counterparts. As they have fewer resources, they are more sensitive to economic downturns. So let's see if you can guess the market capitalization for each of these companies. All familiar logos, but which one is a large, which one is a medium, and which one is a small cap? The mass media company, Paramount Global, has a market cap of 8.8 billion and is a mid-cap. Peloton has a market share of 1.89 billion, making it a small cap. And Apple, as you might have guessed, is the largest company in the world with a market capitalization of 2.72 trillion. Moving on to sectors. For Module 2, you might be familiar with the market sectors and whether they are cyclical or defensive. But just in case you've forgotten, we can have a quick recap. Cyclical sectors tend to be materials, industrials, financial services, energy, real estate, information technology, consumer services, and consumer discretionary, which includes luxury goods, travel, and cars. Defensive sectors are usually sectors that still perform even during recession. They are categorized as consumer staples, healthcare, and utilities. So let's learn more about the different styles of stock that you can invest in. Preferred stocks versus common stocks. Investors have a choice to invest in the common stock of a company or the preferred stocks of a company. Common stocks are also called ordinary shares, and preferred stocks can be called preference shares. But what's the difference between the two? Common stockholders have voting rights, and the company issuer sometimes pays shareholders a dividend. If the business is successful, common stocks will appreciate over time. Preferred stockholders are paid a dividend on a regular schedule and are paid dividend before the dividends are issued to common shareholders. They do not have voting rights, and in the event of an insolvency, preferred shareholders have a higher priority to receive payments over common stockholders. And that can be attractive to some investors. Preferred stocks tend to fluctuate a lot less, so they're a better option for short-term investors who are not able to hold the stock long enough to overcome dips in the share price. Share classes. Some listed companies offer different classes of stock. All companies have different structures for their shares, but traditionally Class A and Class B are owned by the founders or the original equity partners of a company in order to maintain control of voting rights. The different classes of stocks may also have different dividend policies and may be priced differently. Google, for example, offers Class A, B and C shares, In their structure, Class A are common shares, Class B are held by the founders with 10 times voting rights, and Class C are the same as Class A, but they've no voting rights and as a result are less expensive to buy. Value stocks versus growth stocks. One thing that you will hear experienced investors talk about is value stocks versus growth stocks. So what are they and what's the difference between them? Growth stocks are what active investors keep an eye out for. They are companies that are expected to provide high returns because they're on a growth trajectory that is faster than the broader market. These stocks tend to outperform during economic expansion and when interest rates are low. Value stocks are defined as stocks where the intrinsic value of the company is worth more than the stock price it's trading for. This means that the market is currently undervaluing it. It might be because the company's sector is out of vogue or the company name is out of favour. Investors must exercise caution though, as there might be a good reason for the current valuation. Value stocks by their nature generally outperform during an economic recovery. So how would you identify a growth stock or a value stock? This is where you must keep a keen eye out for the finer details. To identify a value stock, you need to look at a company's cash flow. How much cash is it generating relative to its stock price? And what is its debt ratio, which can be calculated by dividing its total debt by its total assets? Is there enough revenue coming in, and is the company paying off its debt? Until recently, Estée Lauder was considered a value stock, with many market analysts recommending investing in the stock as a strong company that was expected to make a comeback in popularity very soon. However, at the time of recording, Estée Lauder has just hit its lowest stock price in years due to weak demand in China and potential business disruptions in the Middle East. For growth stocks, you need to look at companies that have much higher earnings than the surrounding market. Their cash flow and sales are rapidly rising, and they're putting a lot of money into research and development. For example, tech companies, both the well-established and brand new, are often categorized as growth stocks because they're focused on innovation. Just this year, Apple are estimated to have spent $30 billion on research and development. Amazon have spent $42.74 billion. If you're looking at tech startups or not well-established companies, a large amount of research is strongly advised before you make an investment. Is the technology sound, and will there be demand for it? In part 2, we'll learn more about looking at company reports and beginning to evaluate them. For now, though, it's important to remember that when you invest in any stocks, past performance is not indicative of future performance. The value of your stock may go down as well as up at any time. You may lose some or all of the money that you put in. Please join me in part 2 of Module 3. Thank you.